Welcome back, Focus Learners. Look, I am absolutely thrilled to guide you through today's explainer because we're breaking down Microsoft's massive fiscal fourth quarter earnings for 2026. This report dropped on July 30th, and let me tell you, it sent total shockwaves through Wall Street. But honestly, it wasn't just about the sheer massive size of the numbers. It was really a highly strategic, totally surprising move by Microsoft's management that stole the show. So we're going to unpack exactly what happened here and, more importantly, why it matters to you. Right out of the gate, let's talk about 10%. That is how much Microsoft stock jumped in after-hours trading immediately following this report. Now, what makes this a real mystery is the broader context, right? Think about the landscape right now. Competitors like Alphabet and Meta are getting absolutely hammered by investors over their runaway AI spending. It's been brutal. So how on earth did Microsoft manage to trigger a 10% rally while its biggest rivals are facing these massive sell-offs? Well, let's dive into this. Here's our roadmap for figuring it out. First, we'll hit the headline numbers. Second, the Azure and AI growth engine. Third, the big capex surprise. Fourth, market reaction and reality. And finally, we'll wrap up with the analyst verdict. Okay, section 1, the headline numbers. Let's just talk about the pure financial scale of this quarter for a second. Microsoft reported a staggering $90.01 billion in revenue. That's an 18% year-over-year increase. And more importantly, it absolutely crushed Wall Street's consensus estimate of $87.6 billion by a cool $2.4 billion. And the profitability? Just as robust. Microsoft posted adjusted earnings per share of $4.74. That's a full 30% higher than this time last year, coming in 50 cents above the $4.24 analysts were banking on. Actually, if you look at it on a GAAP basis, it was even higher, at $4.81. Just incredible numbers across the board. Zooming out for the broader context, full fiscal year revenue surpassed $331 billion. For Q4, net income hit a record $35.8 billion, up 31%. But, as focused learners, we always want the complete picture, right? So here's the caveat. Part of that massive earnings beat actually came from a $3.2 billion unrealized gain on Microsoft's investment in the AI company Anthropic. Their valuation jumped significantly this quarter. But listen, even when you strip out that $3.2 billion paper gain, the underlying business performance was exceptionally strong. The company rightfully called it their strongest year yet. Moving on to section 2, Azure and AI, the growth engine. Now, this is where the story gets really interesting. The most crucial takeaway here is the acceleration. Azure revenue grew 43% in the quarter. That wasn't just a beat on expectations, it was an actual acceleration from the 40% growth we saw in the prior quarter. For the full fiscal year, Azure revenue surpassed $100 billion for the very first time. That fueled Microsoft Cloud's massive $59.3 billion quarter. And this brilliantly illustrates how AI integration is paying off directly in user adoption. Look at this growth. 6 months ago, Copilot had 15 million paid seats. 3 months ago, 20 million. Today, they've surged past 30 million paid seats. Net seat additions literally more than doubled quarter over quarter. To put that into perspective, NHS England is currently rolling out Copilot to 505,000 clinicians and staff simply because a trial showed it saved workers an average of 43 minutes a day. I mean, that is real-world utility driving explosive growth. But as we know, growth brings its own headaches. CFO Amy Hood explicitly stated that demand still exceeds available capacity. Think about that. Microsoft is literally building as fast as they physically can. They added 31 data centers in Q4 alone. That's 88 for the year across 5 continents. They also managed to slash the time it takes to deploy new GPUs in their largest regions by nearly 50%. This rapid physical infrastructure rollout is desperately needed, especially since CEO Satya Nadella is teasing that a new Copilot super app is dropping later this quarter. All right, section 3, the big capex surprise. Heading into this earnings report, you could feel the tension in the market. Investors were terrified, right? They were watching hyperscalers endlessly dump billions into AI infrastructure, completely terrified they wouldn't see immediate returns. Alphabet raised its capex forecast. Meta watched its stock tank after its free cash flow totally collapsed. So here's the multi-billion-dollar question. With competitors raising AI spending and seeing cash flows plummet, why did Wall Street cheer Microsoft? Well, Microsoft completely broke ranks. While competitors are stuck in this runaway AI spending loop, resulting in Meta's free cash flow dropping a staggering 91%, Microsoft kept its calendar year 2026 capital expenditure expectations completely unchanged at approximately $175 billion. They didn't panic and raise their spending forecast like everyone else did. So, how did they pull this off while still expanding like crazy? It's all thanks to a brilliant accounting twist. Microsoft basically changed the estimated useful life of its data centers and office buildings from 15 years to 25 years. By extending the useful life of these assets, more of their future data center leases shift from finance leases to operating leases. And guess what? Operating leases aren't counted on the capex sheet. So even though Microsoft actually spent a massive $41 billion on capital expenditures this quarter, which is up 69% year over year, this clever accounting shift allowed them to post a phenomenal $19.6 billion in free cash flow. Wall Street absolutely loved the optics of that. Section 4. Market reaction and reality. Okay, let's bring this back down to earth for a reality check. Because despite this incredibly strong earnings bounce, Microsoft's stock remains down approximately 19% year-to-date in 2026, and it's down about 24% over the past 12 months. So the stock still has a lot of ground to recover. The market bears have been very loud lately. They're worrying that Microsoft relies too much on seat-based subscription software that might be vulnerable to AI disruption down the line, and that they're way too reliant on OpenAI for their cloud growth. But the bulls got a major piece of ammunition this quarter to fight off those bears. We need to look at RPO, or remaining performance obligations. Basically, this is a measure of contracted future revenue. Microsoft's RPO jumped an insane 84% to $678 billion. So the crucial point is this. CFO Amy Hood noted that this sequential growth came primarily from companies outside of frontier AI labs. This completely counters the fear that Microsoft is only surviving on a handful of partners like OpenAI. It proves they have a massive, diversified, paying customer base that is locked in for the future. Which brings us to Section 5, the analyst verdict. Ultimately, analysts remain largely bullish on Microsoft's trajectory. While the price targets vary pretty widely, from Scotiabank at $470 all the way up to RBC at $640, the consensus is clearly positive. JP Morgan, RBC, and UBS are all holding strong with buy ratings. The main debate among these top financial minds is whether Microsoft's massive AI investments will actually pay off in the long run. But for this quarter, the answer was a resounding yes. And they are definitely not slowing down. Looking ahead, their first quarter guidance projects Azure growth accelerating even further to around 45% in constant currency. They're projecting total revenue to land between $89.85 billion and $90.95 billion that points to continued, highly aggressive growth. So let's wrap this all up. Microsoft delivered massive top-line and bottom-line beats, proving their core business is incredibly healthy. They proved AI translates to real revenue, with Copilot surging past 30 million paid seats. Most importantly, they managed their financials masterfully, using that steady capex outlook to completely calm Wall Street's fears about runaway spending. However, the valuation debate does remain wide open, with the stock still down 19% year-to-date. They perfectly balanced massive AI growth with disciplined financial optics, but make no mistake, they are still climbing out of a bit of a hole. To close this out, I want to leave you with this really powerful quote from CEO Satya Nadella. He said, "We are advancing the frontier on the cost-to-outcome curve, ensuring every customer can turn tokens into business results." The AI transformation is clearly gaining immense momentum for them. But here's the big question you should take away from this explainer. Can Microsoft actually sustain this flawless execution quarter after quarter to permanently quiet the bears and reclaim its peak valuation? That is the space we all need to be watching. Thanks for joining me on this deep dive, Focus Learners. And as always, keep questioning the numbers.